Yesterday, we heard the news that the US Feds were raising their interest rates by 25 basis points, and today the Bank of England have followed suit and also announced the 11 consecutive increase in interest rates. Why has this been done and what does it mean for you? Don't forget, if you like the content on this channel and you want to see more, please subscribe. I'm filming this video in my work lunch break as the news has just been announced and I wanted to jump straight on it and share it with you guys. So let's get straight into it, no messing around here. The Bank of England have just announced that they are rising interest rates from 4% to 4.25%, so up a quarter of a point. This has gone up from 4% as inflation is still not cooling as they expected. They have a target of just 2% and we are a long way off of that. So they've decided that the action to take is to increase the interest rate in order to try and calm that soaring inflation. Whether or not the inflation rates are actually being reported as accurately and as truthfully as they can be is a whole another question. One of the members on my Discord actually sent me this really interesting website this morning. It's called Reflation, and basically what they've done is they've taken 10 million data points and loads of different resources, looked at all of that and come up with a more accurate, a more true inflation rate based on all of that information. So you can flick between the UK and the US. So just quickly looking at the US, the UK government reported rate when this was last updated, 10.4%. Whereas this website, with all of their information, has actually deemed that the inflation rate sits at more 16.18%, which is way higher than being reported. So I'll try and leave a link to this in the description. It's completely free. Go and have a look, see what you think. To explain why the Fed and the Bank of England are actually raising their interest rates, you have to understand the link between inflation and interest rates. Inflation is a fancy term to describe the increase in the prices of products and services. If you think back to when you were at school, I imagine you remember a time when chocolate bars did not cost you 80p. And I also imagine you remember a time when £10 stretched really far, a lot further than it does today when we can only buy a few things from a £10 note. This is inflation. Prices are going up and your purchasing power is going down. One way to measure inflation and to see whether it's going up or down over different time periods is to look at the CPI. The latest figure for the CPI in February was 10.4%, which was an increase of that reported in January, which sat at 10.1%. So you can see that inflation is going up. Whether that's being reported accurately or not, like we just discussed, is a different question, but either way it seems to be going up, which is not what the Bank of England want. They want to bring that right down. CPI just stands for Consumer Prices Index, and you can see here that it's really been increasing. The Bank of England, like I've said, have set a target for 2%. Right now it is 5 times that, so they're way off their target and they're trying to do something to actually rectify this. And the action that they've decided to take, as we've seen today, is to raise the interest rates. So you might ask yourself, why has inflation actually been rising in the first place? Why is it so high right now? And why does it seem to keep going up? Well, there are a few different reasons for this, but before we get onto that, I just want to show you this other graph that I found that's pretty interesting. This graph is from February 2023 and it's in the UK, but it's a very similar picture across the pond in the US as well. And you can see that the biggest contributor to inflation is housing and bills, followed by food and drinks, restaurants and hotels, and you can see everything else listed here. Now you can also see what the overall inflation rate is with this dotted line, and you can see some of the industries, some of the sectors, some of the categories that are actually way over this. So the inflation in housing and bills is extreme. Food and drinks, again, extreme, sitting at 18%. That's really crazy. And that explains why a lot of people right now are really feeling the pinch. So back to this question of why inflation has actually been increasing. Well, like I said, there are a few reasons. The first one of the big contributors, is the rising cost of energy. As we eased out of lockdown, there was this sudden rise in demand for oil and gas. And whilst this demand was increasing, the supply was actually decreasing due to the war. And it's this careful balance between supply and demand that really dictates how things are going to go. If the demand is really high but the supply is really low, then prices can be raised because there is a demand for it, little supply, therefore you can get people to pay more. And food prices, again, I'm sure you've seen if you visited your local supermarket anytime recently, They just seem to be going up and up. And again, it's because of this supply versus demand situation. You wouldn't really notice inflation as much if you were being paid in line with inflation. So if your food bill was sitting at £50 and it went up to £100, but your wages also increased by the same amount to cover that difference, you wouldn't really notice anything. But if your wages are only being put up by a tiny percent, but yet your food bill, your housing bill, your mortgage, everything else is going up by even more, you're going to start feeling the pinch a lot. So now onto this link between interest rates and inflation, and it's an important one to understand. I'll put up a graph now that shows you the general relationship between interest rates and inflation, but typically and traditionally speaking, if the inflation is going up, so prices are going up, the response normally is to raise the interest rates as well following that increase. Raising interest rates basically means that borrowing becomes more expensive. And it can mean that some people with mortgages can actually see their monthly payments go up as well. You also may see that saving rates begin to go up, but we'll get onto all of that in just a minute. When people have less money, when interest rates go up, they tend to buy fewer things. This then pushes the demand for goods and services down, which in line brings the prices down as well. So raising interest rates is basically a way to help reduce the overall level of demand and therefore hopefully reduce the upward pressure on prices that we see. So now what we've seen is that when inflation rates rise, so the cost of living goes up, we see that interest rates typically get risen after that to try and bring inflation back down. So what does all of this mean for you? Well, it could mean mortgage increases. When interest rates rise, some people on variable rate mortgage deals actually see an immediate increase in their monthly mortgage payments. So an increase in the interest rate from 4% to 4.25% that we saw happen today means that those people on a typical tracker mortgage actually pay about £24 a month more. And those on standard variable rate mortgages would expect about a £15 rise. Now, people on a fixed rate mortgage are not going to see any difference because they fixed a rate in. But this also does mean that any new house buyers or anyone looking to actually remortgage their home will have to pay a lot more now than if they had taken out the same mortgage a year ago or in the past. The next area where this will likely affect you is credit card and loans. Lenders could basically just put up interest rates on loans and credit cards, which in theory means that borrowing more money becomes more expensive for you. And again, this is because they want to make you borrow less so that the demand goes down, you can't spend as much, and inflation in turn goes down as well. It's all a linked process. The next area is saving accounts. Now, when I speak about this, it's going to sound very positive, but make sure you continue listening because there's something else to be said here. Banks will usually pass on this increase in interest rates down to their customers. So I'm talking about the individual banks and building societies specifically here. This means that you as a customer will now be able to get better rates than you have been able to for quite a while. That sounds pretty good. You know, you're going to put money into a saving account and that money is going to make you more money than you've been able to make previously because the interest rates are rising. So what I would say here is that definitely to use this opportunity to shop around. Look for the bank accounts that are going to give you a better deal. Really try and optimize this. But something that you should know here is that it's not all daisies and sunshines because the interest rates are not keeping up with inflation. So even if you're now getting a better rate than you have before, your cash savings are probably still falling in buying power. Now, we talk on this channel a lot about investing. You know that I love investing, and I know that most people watching this video also have a strong interest in investing. So let's just talk about how this whole interest rate rise and inflationary environment could affect your investing. Generally speaking, interest rates and stocks tend to move in the opposite directions. As interest rates rise, it becomes more expensive not only for us to borrow money, but also for companies and businesses to borrow money too. And this just essentially increases the cost of that business, well, doing their business, which then of course in turn can lower profits and can reduce the stock prices that we see when we're doing our investing. When rates rise, when we see this 0.25% rise that we're seeing today, In theory, the whole idea is to make cash savings more attractive than ever. If the savings in your bank account are making what you think is a decent return, you might shy away from investing because you think your money is best spent in a savings account, or in cash or wherever else than it is maybe in an investment portfolio. Personally, I do not view it like this. I'm going to be continuing to invest and continuing to build up my portfolio. I hope actually that this causes some dips in my position so I can scoop up even more shares for the same amount of money. But either way, my plan is not to let emotions get in the way of my investing. Whether the stock prices fall or they go up or they stay the same, I'm going to continue to buy because my portfolio is a long-term thing. I'm not trying to trade in and out every day. I am building my portfolio for my future. However, I will also use this opportunity to look around at some different bank accounts because I want to optimize the money that I do have in my bank account and I want it to make as much money as it possibly can. If I see a bank account offering a better interest rate and maybe even some money reward to actually move over, I might consider doing that. Another thing to be said is that, again, typically speaking, we don't really know what's going to happen, but just looking at the past, growth stocks are likely to become the biggest losers when the rates go up. I'm not bothered about this, but you can decide whether this is something you want to feel emotionally about, or you can just try and stay completely non-emotional and just continue investing and following your strategy. Rising rates also have this chance of actually making bonds seem more attractive to investors compared to the stock market. And this is because bonds offer a fixed rate of return, whereas stocks offer a variable rate of return. When interest rates rise, people value this fixed amount that you can get, this fixed return on an asset. It's kind of the same with dividend stocks as well, but of course there is a business behind a dividend stock and that business may also feel the pinch from these increasing interest rates. My personal opinion is that if you're investing in good quality companies, they may see an immediate short-term dip in their stock price, but overall they're going to survive because they're quality companies and they've survived in increasing interest rates time and time again. So just think about that, but let me know your thoughts on what's happening right now in the comments below. And if you want to become a Patreon and join my Discord, then again, I'll leave a link in the description. Thank you so much for watching this really off-the-cuff video. I hope that you've enjoyed it. I hope maybe it's given you some things to think about and maybe just de-stressed you a little bit. But yeah, leave your comments in the comments below and I'll see you in the next one.